That's why when you hear people in this channel say, oh my God, it's mooning. It may not be mooning to you because you saw this move up 50 cents, which represents 2%. But these people just made $26, $27 per contract, which means they made about 15% return. That's a moon to those people. Okay, ladies and gentlemen, boys and girls, here we go. Options. Before I get started, number one thing to being successful is discipline. The reason that I say this is because when you lock in your gains, you need to walk away. Greed and bag holding will destroy you every single time. They will destroy you, okay? You get 20%, you want 40, next thing you know, you cut with a loss. Or you're down a certain position, a percentage, and you're like, well, I'll just keep buying more. I'll just wait for it to go back up. It will keep falling and you will lose everything. Discipline is the number one key to success in options trading. It's more important than finding even the plays to make, okay? Now, what is an option? An option is a contract that basically says you have the right to own 100 shares of that stock at the price that you bought the strike price for. So we are focusing today on a $23 Palantir call that expires on April 30th. What does that mean? That means if Palantir is above $23 or higher on April 30th, the owner of that contract has the right to take 100 shares of Palantir from the person who wrote that contract at $23. If it's if the price of Palantir is $23.50, or if it's $50, it does not matter. You get 100 shares of Palantir at $23. That is why people like options. It allows you to take a smaller amount of money to purchase something down the road for a potential larger gain. Now, there are several things you can do. You can buy that contract and sell it back into the market for a higher value to somebody else who wants those shares. Or you can exercise it. Or, worst case scenario, Palantir ends Friday at 22.99. Your contract is worthless. It was already basically worthless, but it's worthless. It has to be into that strike price, okay? Exercising, once again, means you basically own that contract. The day is over on 4/30. It's $25, and you say, hey, person who wrote this contract, yeah, I'm exercising it. In other words, I want my 100 shares of Palantir at $23 a piece, which means you pay $23 per share times 100, $2,300, no matter what the price is. If the share is $40 on the 30th, it doesn't matter. You only pay what the price of the strike price is times 100. There is a lot of small things I'm going to miss, but I just want to give an overview. Now, before we move into any further, that is what a call is. A call is that the price of the stock is going to go up. A put is down. So if you think the stock price is going to drop, that is a put. That is a bet against it going down. A call is it going up, okay? A weekly, when you hear weekly, it generally means expiring the same week or within 2 weeks. A leap is a lot longer, 6 months to a year or more, okay? Why does that matter? We're about to get into that, okay? When you look at an option, depending on your brokerage, you're going to see several things. So the first thing you need to decide is what direction do you think that stock is going to go up? Go up, or is it going to go down? That's the first thing. Then the question becomes, how much capital are you using and in what time frame do you think? In this case, this contract right here, okay? If I were to buy this contract, all right, the current price of Palantir is $23.10. I am guessing and expecting it to be above $23 by April 30th. It currently costs me $1.46, which means because there's 100 underneath it, you're timesing everything by 100. So this means that this contract at $1.46 times 100 is going to cost you $146. You are now paying $146 for the right to own 100 shares of Palantir at $23 a piece by April 30th. What determines this price? And is it going to go up or is it going to go down? That's where these numbers come into place. Okay? The shorter the time frame for expiration, the less likely it's going to get there. The further out of the money, in other words, the higher the strike price, the less likely it's going to get there, and therefore your premium is cheaper. So when you see people dump a whole bunch of money into into something that is like very cheap, $5 a contract, that's because the chances of it actually getting to where it will be exercised is almost zero. The better the chance, in other words, the further the time frame or the closer to the actual strike price, the current value of the stock is, the more expensive this becomes. What's the cheapest? Something that's very far out of the money that expires in a very short period of time, because the chances of it getting there are almost zero. So therefore the value of that contract is nothing, right? It's like, you know that you're not going to get there. All right. It's kind of like layaway, right? Stock options are kind of like layaway in a way. It's kind of like you go to the store and you say, hey, I really want this TV. And it's on sale. All right. It's currently at, $799. And you say to them, I want this at $799, but I just don't have the money for it right now. And they say, that's cool. If you give us $100, we'll hold it at $799. And if the price of it goes up down the road and you come back, we'll give you that $100, we'll give you that TV at $799. Even if it's worth $1,200, you get to keep it at $799. That's kind of like what options are. Now, if the price drops between now and then, we keep all your money. All right? That's kind of what options are like. It's kind of like I'm giving you a layaway item or layaway mark because I want to buy something at a certain price. I want to lock in what the price is now. So if the TV goes up to $2,000, doesn't matter. I get it at $799. But my little ticket becomes more and more valuable because I paid less for something that now costs more. So my little $100 ticket, I may not want the TV after a while. I may say, you know what? I'm moving. I don't want the TV. But somebody else wants it. It's a $799 TV going for $2,000. I'll give it to them for $1,000. I make $300. They get to save $1,000 on the TV, right? The higher the price of the TV, the more valuable that ticket becomes. And that's your options contract. So let's get into the actual numbers here. Your bid and ask. What is your bid and ask? Your bid is how much people are trying to buy these contracts for and how much people are trying to sell them for. So you have 10 people trying to buy this contract for $144. They want it low, right? You always want to get a better deal. You also have 10 people, sorry, 145. You also have 10 people trying to sell it for a profit at 147. So these guys are trying to get a deal on it, and these guys are going to sell it for a profit. So what does that mean? That's your mark. Your mark is, where is the median price right now? Right? Where is that price at? If 145 people, or if 10 people want to buy at 145 and 10 want to buy at 147, the middle is 146. And that's where you get your price here. That's where you get your price. That's your mark. Now, you have to pay attention to the ask bid spread. And the reason I will say that, this is the most overlooked thing outside of volume. And the reason I say that it is so important is because, let me show you something. $145. That's what the mark is. But no one is going to budge off of these numbers because it's too far away. Let's say this is 100 and this is 200. Technically, the mark is 150, but you're not going to be able to buy it for 150 or sell it for 150. Okay? If you put a market order in to buy it, you're going to buy it for the top end. If you put a market order in to sell it, you're going to sell it for the low end. You're going to lose money regardless. You don't touch options like this. And the reason I say that is, let's say you even get it for 150. Let's say somehow it's a miracle and you get it for 150. Okay? Now all of a sudden, you're the only one owning this. There's two bids at 100, and you're trying to sell it for a profit at 200. Now it's worth 125. You've already lost it. You've already lost money on it because that's a large spread. I don't want to get too complicated there, but I will just keep that as something to keep and understand. Understand the ask bid and the volume. How many people are doing it? This is very, very important. It's just like with owning a equity, right? When you own a stock, when you're buying a stock, you want to make sure you have something that has high volume and has a very tight ask bid spread, because then there's a lot of people trying to buy it and you can easily buy it and sell it for a good price without worrying about someone else with a large order coming in and destroying you. I've seen people buy an option, the option go up, and they lost significant amounts of money. Okay, so let's go back to what it was. It was 144 times 10 and 147 times 10. Okay, that's the ask bid, okay? This is your bid, how much people are trying to buy it for. This is your ask. This is how much people are trying to sell it for, okay? Now, let's move on. What does previous mean? That just tells you what the previous day's close was. This contract ended the day at $140. It was worth $140, which means it's become more valuable today. That means the underlying stock has gone up. The high of the day today is $150. That means the highest this thing sold for was $150 a contract, and the lowest was $128. Okay, that means at some point, probably earlier in the day, there was a dip and it's moved back up, or there's been more interest, which has grabbed the value going up, okay? That's your previous, your high, and your low. Volume and open interest. This basically tells you how many contracts are out there and how many of them are being traded. The higher this number, usually the closer the ask bid, and the more popular are. The more popular they are, the more demand there is, the more value there is as it moves in the right direction, which then moves into your implied volatility. Obviously, you don't want something that has one volume and one open interest, because then you're the only one playing it. And if nobody else wants to play it, you're playing with yourself. Well, not with yourself, by yourself. Basically, there's nobody there. When you throw the ball to play catch, no one's catching it. You got to go get it yourself. You're losing, all right? This comes to what is very vastly overlooked, and that is implied volatility. Stocky, what does IV mean? What does implied volatility mean? Implied volatility simply means expected movement, okay? Implied, expected, volatility, movement. How much movement is expected in the stock? Well, lots of factors can come into that. Earnings? We expect a big movement one way or the other. Spikes IV. You have an announcement that's coming out. Spikes IV. You have another company within that sector making a big move. That could bleed over to this one. Spike. Momentum. You see a stock normally move like this throughout the day, then all of a sudden it does this and it's still going? Well, shit, if it's still going and the volume's building up, we're expecting this to continue to move really quickly one way or the other. Implied volatility goes up. As the implied volatility goes up, you get an increase in that premium, right? The more implied volatility, expected movement, the more value, because now all of a sudden people are like, well, shit, if this thing's going to keep moving and going to be moving fast, this shit might be worth a lot. Let me jump in on it now. Let me jump in on it now. Let me get in on it, right? It's a demand, right? The more in demand something is, or the more likely it is to get where you want it, the more people want it, right? Like, oh shit, now this thing is moving 5% today, and I only need 4% more in the next year to get in the money. I want it now before it's too late. So as IV, implied volatility, expected movement goes up, the value of the contract goes up. Then comes the IV crush. I know you guys have all heard IV crush. What is IV crush? Basically PNC. I'm going to be real with you. That's what it is. IV crush is PNC. All the artificial value that is built up in this contract because of that expected movement, once it's over, it's exploded, the movement's over, it's all gone. Comes crashing back to reality. So let's say this is 146 and all of a sudden Palantir says, hey, we got a big announcement tomorrow. Oh shit, people are jumping in, they want to know what it is. This thing goes to 250. Well, that means 104 of that is implied volatility, right? It's expected movement. Once the event's over, well, the event is over, so all that value is gone. So if you bought at 250, once that event's over and it doesn't keep moving, you lose all that, you're down $104 a contract. That's why you hear earnings, IV crush. So when you look at it, you'll see the IV will say 180%, right? That means once the earnings is over, or that event is over, most likely 50 to 75% of that is gone. So you're like, well, I've got to price that in. So if I bought at 250, I got to expect 125 is gone. So that means I've lost 50%. Well, Stocky, why would I buy something that I'm expecting to lose 50% on? That, ladies and gentlemen, is where the most important thing is the Greeks. Delta is the amount of value the contract gains per dollar that the stock gains. So the delta on these contracts is 54. That means for every dollar the stock goes up, the contract gains $54. So if Palantir goes from 23.10 to 24.10, the expectation is that these contracts will now be worth $200 a piece. That's why when you hear people in this channel say, oh my God, it's mooning. Well, it may not be mooning to you because you saw this move up 50 cents, which represents 2%. But these people just made $26, $27 per contract, which means they made about 15% return. That's a moon to those people. Now, what's the next one? Gamma. Gamma is what you add to the delta for the next dollar. So in this case, gamma is 11. That means if Palantir goes to 24.10, you add $54. If it goes to 25.10, you now add 54 and 11 together. That's 65. That means the second dollar you add 65 to this. That means if Palantir goes up to $25.10, your contracts are now worth $265 a piece. That means a $2 move on the stock, you gain 60, 70% value. Applies for losses as well. Yes, guys. Okay, so that means that the first dollar followed by the second dollar. Okay, and then you just add this to this dollar for the delta for every dollar up, right? And now it's $265 a contract, even though you bought it at 146. Why is the value going up? Because the chances of this expiring in the money are significantly higher. Gamma can change, yes it can. The next Greek is Theta. This is why you guys keep losing all your money by holding overnight on weeklies. Theta is the amount of money, the value of these contracts is lost every night you hold them. Okay, in this case, Theta is 0.03. That means if the stock is 23.10 now and it opens tomorrow at 23.10, there was no movement, you lose $3 per contract. I'm going to be real with you guys right now. If it wasn't for the fact that this was Palantir, I would buy the fuck out of anything that this is. These numbers right now, a delta of 54 to a theta of only 3 is insane. This is a options trader's wet dream. But we know Palantir has just been flatlining and breaking hearts. So it's almost like a trap. Okay? If you give me a 3-week expiring options contract that costs 146 bucks with a 54 delta and 11 gamma and only a 3 theta, my ass is all in usually, but it's Palantir, okay? Now, theta is the amount that you lose in value of contract every day you hold it. The closer you get to expiration, the higher exponentially this goes. For example, this is 3 weeks to expiration. Usually it'd be higher percentage, but it's at 3. A week from now, this will probably be 11. 2 weeks from now, it'll probably be 30. The last few days, it'll probably be 50. That means 30% gone by holding overnight. And you have to have a significant move the next day just to break even. That's why theta is important. That's why we always talk about leaps here on the channel. Because leaps, generally a year out, your theta is at like 0.01 or 00. Meaning that you're not losing any value holding it overnight. And that's super important because it could be a long time with a choppy market until your option gets close to the strike price. And therefore, you don't want to lose value every day. The closer you get, your theta line generally is going to look like this. Okay? This is 1 year. This is 6 months. This is 3 months. 1 month. 1 week. That's how your theta goes. Okay? As you get closer, it just exponentially goes higher. That's why you want to grab a leap and hold it for 6 months until you get comfortable. Unless you're planning on exercising it, then it doesn't really matter, okay? Theta is very important. I'm not going to talk about Row because unless you're an institutional guy, it really doesn't matter. But Vega is another one that people don't realize. What is Vega? In this case, Vega is 0.02. This basically is where the implied volatility money goes. So you say to yourself, Stocky, how does the implied volatility increase the share, the value? For every 1% your implied volatility goes up, your call option goes up by that amount. So it's currently at 146. Let's say implied volatility, which is currently at 62.29%. So they've priced in a 62.29% movement from here. If implied volatility goes up by 1%, the contract goes up by $2. That's why IV Crush is so crazy. All that premium that's gained from the IV going up, once the implied volatility event is over, all of that disappears. And that's where IV Crush is. Back to what we were talking about with Palantir and with options. Okay, so we actually got to see it happen in real time. So remember how we talked about it was going to depend on, you know, all these different Greeks, right? So we ended up actually seeing Palantir move up to $23.50 for a minute there. Actually, let me see where the actual top was. So right after this happened, we actually saw Palantir move to $23.53. So it went from 23.10 to 23.53. So we saw it move 43 cents up. Remember what the delta was at 54? We ended up seeing that contract go up to $160 because not only did that delta move the value of those contracts, we saw the implied volatility start to move. Why did the implied volatility start to move? Because we saw a rapid movement up. So that expected movement started to increase. We started seeing a higher ask bid spread. We started seeing that money. Now, what are some of the downfalls? What are some of the downfalls and what are some of the good and bad things? So when you get something that is a weekly, remember, the cheaper the contract, it's usually because the closer to expiration date, so like tomorrow, 4/9 will be the cheapest. Next week, so on, they get more expensive because there's more time to get into the money to exercise them. And the further out of the money. So at $23, when it's currently $23.10, you're at the money. A $30 is very far out of the money. So it becomes cheaper because it's less likely. So while it is less money to purchase those contracts, the chances of you actually profiting on them is very, very small. One of the biggest options mistakes I see people do is buy something out of the money for cheap, the underlying drop from 23 to 22. So their contract goes from, let's say, $50 to $30. And what do? They buy more to average down. Well, if I double up at 30, it only costs me 0.40 average, so then I'll make more money. But that's not how it works. The further out of the money and the closer to expiration, the less desirable and the more dynamic move is needed for that to make value. These drop to 30 because they're less valuable. And you have theta. Unlike a stock where you just carry the balance day over day, you're losing value every day. The closer to expiration, the more exponentially you lose. All you're doing is adding more money to a losing position that is going to go to zero. I don't think enough people understand this. If you have a leap, you can do this, okay? If your XY axis was expiration date and money, okay, in the money, out of the money. The further out and the closer to the money,
welcome half
okay,
gang.
All right, significantly, okay? The further out the expiration, the closer to the money, the more valuable those contracts are. The closer to the expiration date and the further out of the money, the cheaper they are. So, while it may cost you much less to buy it, the chances of, the reason it's so cheap is because the chances of it actually getting to the money are so small. If the actual stock drops, now it needs double the move for it to even make money. And then you'll say to yourself, well, the delta is 54. So if the stock drops, it's fine. $1 move. No. This also goes away. Okay? It's fine if you want to gamble on what we call weeklies or out of the money weeklies. So an out of the money weekly would be a $25 tomorrow expiring call on Palantir. You need 10% move before tomorrow for this to be worth money. Now, can it still become valuable? Sure, it's a gamble. Shit probably cost you $10. And if some reason some good news comes out and Palantir jumps 5% overnight, it might go to $20 and you made 100%. It's still shit for anybody trying to buy it from you tomorrow, but for them, it's $20 for a YOLO. You've doubled your money. Yeah. But the chances of this actually making money, because the Theta is probably 10 as well, that means tomorrow it's worth 0. All right? I'm not trying to overcomplicate this. I'm just trying to give you guys a little bit of an understanding. There's so many more things. If I were to say what are the biggest mistakes that options traders make, especially new traders make, all right, I did a video on this, but the first thing is not understanding the bid-ask. Okay, not understanding that. Not understanding the volume and open interest, the desirability of them, okay? Buying out of the money or weeklies without understanding that these are complete degen gambles and you do not add more money to these. If you're wrong, you're wrong. If it's a weekly or it's you just whatever money you buy originally, it better be what you're willing to lose. You do not if it's more money than you would go to Vegas and put on a single number of roulette, then it's more money than you should put on this. Okay? That's how it is. Options, there are several other layers to options, guys. There are buying options, there are selling options, there are selling covered calls and covered puts. There's naked calls, there's spreads, there's iron condors and butterflies. There's a whole bunch of stuff. But everything I just said earlier was basically a understanding of the basics, absolute bare bones for buying and flipping an option or exercising an option. Here's what I will tell you. The number one rule to being successful is discipline, okay? I don't care what everyone says. You better have a plan going in and you better stick to it. Even if it goes up, you sell and it moons, you can laugh and joke and pull your hair out and say it happens every time, but you stick to it. Because here's the problem. The second an option, especially a short-term option during high volatility, the second that the actual stock starts to go sideways, you start losing value exponentially, especially if it's short-dated. Because everyone wants to get to that exercisable date. They want to be able to get it in the money. And the longer it takes to get there, the less likely it gets there and the less value there is. So, when you're playing a weekly, you guys often see, I'll see the stock do this and start to curl, my ass will sell right there. Because even if it doesn't drop, let's say it slowly goes up to the rest of the day, the value of that contract starts to dip. You know, but Stocky, the stock's going up. Why is it going down? Because the implied volatility there. The expected movement's gone because it's flatlining. The time that I have to get to the expiration is disappearing. It's less likely. It's less desirable. Therefore, people are less likely to pay more money for it. Think about it. No matter how ugly you are, the more money and more success you're making in a shorter amount of time, the more attracted people are to you. The more desirable you are. But the second your mediocre-looking ass gets the vice president in your company and stays there for 10 years, the less likely the secretary is going to bang you thinking she could get a raise because you're not the less likely you are to become the CEO. I mean, if you were CEO material, they would have made your ass CEO 5 years ago. You've been a VP for 10 years. Listen, you were a good ride on the way from supervisor to vice president. Listen, but now this other hotshot's riding up and he's probably got a chance. I'm done with you. Same thing with options, okay?